ESG probably confuses investors in Australia. I increasingly talk more about ESG in Australia more as responsible investment. And I think investors here, once they sort of put those two words together, they kind of get what ESG is. It's not green. It's not that part of ESG. And I think that's where Australian investors are still very confused about, what it means.
Hello and welcome back to The Greener Way. I'm Jamie Williamson, Managing Editor of Financial Standard. In recent years, private credit has been just about all people can talk about given its massive growth here in Australia. And quite often that discussion has focused on the negatives of the sector, namely its opacity when it comes to things like credit quality and valuations. And while this is something the industry and ASIC are trying to move the dial on, there are some players out there who are leading by example when it comes to transparency and driving best practice, one of which is Woodbridge Capital. Woodbridge is an emerging manager in the private credit space, recently expanding with its first Sydney office, and at the heart of its approach is a strong focus on ESG and sustainability. And to talk us through this, I'm joined by its co-founder, Andrew Torrington. Andrew, welcome to The Greener Way.
Thanks, Jamie. Lovely to be here.
Now, Andrew, you've had a long career in real estate. Can you give us a quick overview of that and then how you've gone on to found Woodbridge?
Yes, I guess I'm a little bit different in our space than I'm a crusty old real estate guy, if you like, playing at sort of all sides of real estate. I've been in private credit sort of for 10, 12 years, set up my own fund in 2021. The catalyst for that really, and you mentioned a little bit earlier, is that private credit's changing in the market and that there was two themes for me, was to bring out a fund that was transparent because, we are in a very opaque asset class. And the second thing was to bring out a fund that had ESG credentials wrapped around it and in the nicest way, true ESG, not just, ESG for the sake of being seen to be ESG, but a fund that was, genuine on two fronts, genuine on ESG, responsible investment, and, genuinely giving transparency to investors. And I think that's the new, the new breed of private credit funds. I think that those two core themes, are important to investors now.
Now, you've already kind of touched on it and I did at the top as well, but ESG, you really do put those credentials front and center of your offer and in your work. Why is that so important for the business?
Yeah, listen, I think as everybody will know, ESG in Australia adoption rate is quite low and investors in Australia are often quite confused about what the E, the S, the G means. And, I'm very much used to dealing with North American investors, European investors that, embrace ESG. It's a lot more positive undertone. So for me, getting our funds RIA certified was the start of our process, just making sure that, investors understood what it was. And then, we, for our investors, we're offering responsible investment. And, we can maybe talk about this, but to me, ESG probably confuses investors in Australia. I increasingly talk more about ESG in Australia more as responsible investment. And I think investors here, once they sort of put those two words together, they kind of get what ESG is. It's not green. It's not that part of ESG. And I think that's where Australian investors are still very confused about, what it means.
So what does ESG implementation look like for you from both the mandates from asset owners and then when it also comes to your lending?
Yes, it's a good question how that relates to private credit because obviously as, we're lending money to owners of assets. So we don't own the assets. We're lending money to those assets for a short period of time, typically 1 to 3 years. And the question for ESG, so what's our responsibility as lenders in those assets for the periods that we're lending money into those assets? So for us, we have screens on assets. So, we're screening particular assets that we won't get involved in. And, we're telling our investors what assets we are involved in. And I think, different investors obviously understand ESG very differently. So our ESG investors, our institutional investors, understand what our ESG screening is doing. Our wholesale retail investors probably don't understand that as much about what the ESG screens are. But, if I ask a wholesale retail investor, for example, do you want to invest in, or, do you want us to lend money into an adult entertainment venue? Those investors will quite quickly say, no, that's not it's not where I want my money put to. And I guess what I'm always saying, well, that's ESG. That's what ESG does. we can call it responsible investment because it's that as well. But I think wholesale retail investors are still quite dismissive of ESG. They don't understand it. They think it's green. They tell you they don't care. But as I say, as soon as I ask them, do you want to invest in adult entertainment, or are you comfortable us investing in, poker machine venues in low socioeconomic? The answer is almost always no. And that's what we're always explaining. Well, that's ESG. And I think Australian investors are still quite far removed from understanding that impact, and how for private credit funds, that's our pledge as responsible investors, to invest in assets that aren't what you want to be invested in as an investor.
So how do those ESG screens actually impact the loans that you do approve? Can you maybe give us some examples? You've kind of touched on a couple already, but just examples of projects that would or would not be suitable for funding from that perspective?
Yeah, so like all good ESG shops is that we have screens on our investments. So there's certain assets we can't invest in, and for us, it's we can't invest in petrol stations, adult entertainment. We can't invest in pubs, alcohol venues, poker machine venues. We can't invest in inefficient buildings. So if it's in Australia, we use neighbours ratings for buildings. So if it's a 3-star building, we can't invest in those type of buildings because they're not, it doesn't satisfy the he, if you like. And then practically, we can't invest in low socioeconomic areas where there's assets taking advantage of that. So that's our community screens. So all this just means is when we look at our investments, yes, our screens take out some of our loans, and that might be 10, 20% of investments we will look at, but politely, that doesn't affect our returns. This just means our pool is being screened responsibly, and that the assets we choose in pass our ESG screens, and then we launch into due diligence where we're verifying all sorts of stuff, obviously, but also the ESG is real.
Yeah.
And that, we aren't inadvertently stepping in on assets that, aren't socially responsible or are taking advantage of, poker machine venues. So, yeah, we like to think it's pretty practical. Again, this is not the investment side. This is the responsible investment side. We're capitalists, of course. We're here to earn our investors a good risk-adjusted return. But yeah, responsible investment to me is not social. It's that ESG bit is linked in with transparency. Investors know what they invested in and they understand it. They can see it. And if they don't like what we're invested in, they've got clarity to pull their money out if they so choose. So that's what I think RI and transparency link.
So ESG, it's been described by some as being in decline, and it's kind of interesting that you mentioned earlier that you find that you have kind of more successful conversations with people in the US, for instance, because obviously, a lot of the anti-ESG sentiment that has kind of been around for the last 12 months or so has sort of stemmed from there, really. But what's your view of the importance of ESG considerations in private credit?
Yeah, so I wouldn't agree that ESG is in decline. I think internationally, sure, it's probably peaked, but it's well governed, well regulated, well understood. I think Australia, I don't think it's peaked in Australia at all. I would argue the opposite. I think responsible investment is very much on the rise. I think we have to change the language in Australia to RI, not ESG. And certainly as a firm, I have pivoted to talking about ESG now as not ESG, but it's RI plus ESG. And as I mentioned before, investors care. And when we talk about our assets and I ask them if they want to invest in certain assets, their answer is always no. And so investors do care what they invest in Australia very much. I think in private credit funds, increasingly, we are being asked on the RI side what we are investing in. So I think it does matter. I think there's an educational piece in Australia. I'm always advocating RIA to better educate advisors as well, because in Australia, it's just straight education. Wealth advisors don't understand ESG as much as they should. They're probably a little bit dismissive of ESG and how it relates to funds they invest in. But given 10 minutes and you explain it to them, they very much embrace it. So that's why I'm a big believer that it's alive and well in Oz. I think it would get more acceptance. But I think as an industry, and you're seeing this with a lot of funds now, we are talking about this as RI, not ESG. And that is us as investors going, we still care. People do care, but we've got to change the language around it.
We've said that you're a big advocate for transparency in private credit. Why is this important? And what are the risks to investors if a relationship with a credit manager is opaque?
And again, Australia's getting used to private markets, yeah. So, Europe, US investors have been coming into private markets for many years. They're well regulated, particularly the US, where you've got the SEC regulating private markets, as in private credit, private equity. Lots of discussion in Australia from ASIC about they will start to regulate private credit. Clearly, they're too late, as in that they're well overdue, is that private credit is well alive here. So our regulator is a long way behind. And what suffered from that, of course, is transparency. Investors are coming into private credit without a regulator, are rightly so concerned about when they put their money in these funds, what's in there.
Mm-hmm.
And what happened in Australia in private credit is, many billions have been put into private credit, into managers, and investors don't know what the loans are. They can't see the underlying loans. And that's when we talk about opaqueness in the industry, that it's that. Now, investors would never have done that in an equities fund. They would never invested in an equities fund with 12 equities and not ask the manager what they were. But for some bizarre reason, our industry is being able to get away with that. So now link that in with ESG is that how can you be ESG if you can't see the loans? Because if the manager's claiming to be having ESG screens, how can the manager say that but then not show you the loan book? So ESG and transparency are absolutely interlinked. And when I say ESG is a hot topic and not dying, it's because of transparency.
Mm-hmm.
If you look at in Australia, our only governance in private credit at the moment is really RIA, bizarrely. So, RIA, both of our funds are RIA certified. They're the only voice of RI in the market. Our funds are audited by RIA, unlike ASIC. So it's kind of strange that RI is probably closer to regulation of funds that are certified than our regulator. And I think that, RIA is forcing transparency of funds that claim to be ESG. That's a good thing. And I think as the market accepts what RI looks like, I think increasingly the regulator will step in and also assist with that. And that transparency will drive the ESG, because when investors can see what's in some of these funds, they might not like what they see, both from the investment side and an ESG side. They might not like that the manager is investing heavily in, petrol stations, for example, or, gambling.
Yeah.
So, I think good for the asset class. Transparency is always good in private markets, but investors are discovering it's different. You can't Google investment managers in private markets and see what they're investing in, unlike public markets. And Aussie investors are slowly getting used to it.
We've touched on ASIC. Obviously, they put out their discussion paper earlier this year that was in relation to the dynamics of Australia's public and private markets. I think the other day they said, Simone Constant said that, the outcome of that would be coming out probably in November. So that's one thing that we've got coming up. But looking ahead, what else do you see is going to be influencing this space, and how do you anticipate Australia's private credit sector is going to evolve?
Yeah, so probably the first thing I'd caution, Jamie, I don't think ASIC will come out with a silver bullet. Not to be skeptical, but I don't think they're going to come out with the whole thing. I think they will come out with a view, or hopefully with some regulation. But I think investors coming into private credit, don't wait for ASIC. It's probably what I'd say, is that they're coming, but this panacea is not going to be fixed in 3 months. So that's a challenge for investors, and I get it, because without the regulator, you're very reliant on the honesty, integrity, transparency of the manager in private markets. So, we're always advocating, not just for us, but, know your manager, talk to your manager, ask to see the loan book. If the manager won't show the loan book, don't invest. That's silly. Demand transparency. So I think, I'm very positive. I think, the regulator's coming, which is a good thing for our industry. It will clean up a lot of the noise in our industry. Increasingly our investors are asking the right questions, and they're getting used to what to ask a private credit fund. And that's a good thing. We are big educators into the wealth advisory. So to be honest, we spend more time educating the market than selling to it to invest. And the more and more, the wealth advisory market understands credit, and the better they get at screening managers, you would hope, clearly we like to be seen as a good manager, but you would hope the responsible managers prosper in that environment. The managers that, a high risk to their investors won't prosper in the coming years, and that as an industry in X amount of years, we'll have I think a good mix of RI funds, a good majority of very transparent funds. Private markets is alive and well. Public markets in Australia, I think, has changed now forever. I think IPOs, relying on an IPO to raise capital in Australia, I think is permanent now. So non-bank lending in Australia is probably at best maybe 20%. It's 60% the US, it's 50% Europe, it's 55% globally. So I think now it's non-bank private credit's coming. It is part of our economy now, and investors are embracing it. And to me, there's two core parts of it, and it's responsible investment and it's transparency, and don't pull them apart. Keep them together because they're both very much linked. So, I'm probably like a broken record, but I don't buy into ESG's debt at all. I think investors, the more they see it, the more they understand it, and I think Australian investors will embrace it.
Well, it's certainly going to be interesting to see how it evolves, and if that happens, I'm sure it is going to happen. It may just take a little bit longer than we might like, but thank you so much again for taking the time with us today, Andrew. It's been really lovely chatting to you.
Okay, thanks, Jamie. Love a chat.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.